This is Jeffrey Cohen. I'm going to share the screen, the presentation with everyone. And I saw a question. Yes, we will share a copy of the slides. It may not be every slide, but it will be the main content that we discuss. So if we discuss it, you'll get a copy. So I'm Jeffrey Cohen. We started Chicago Quantum, which is a service mark of U.S. Advanced Computing Infrastructures Incorporated, which is an Illinois corporation. We started it in 2018 to bring quantum computing to kind of regular corporate enterprise IT shops. The idea was we saw quantum computing having a potential to add business value, and we wanted to bring it forward. And then about halfway, through the movie, we changed the story a little. And we said, it's too much to try to sell to big corporate enterprises. Why don't we pick one problem? And so we picked portfolio optimization, or how to pick stocks efficiently. And we figured we would give the quantum computers a chance to kind of take on that problem, which has allowed us to go very deep. And so that's what fundamentally started our race, which is, can a quantum annealing computer do as well, provide equivalent solutions to the other discrete mathematical models that we're all familiar with? And so you're meeting 3 of our team members, and we are, we're available to take client work. And so the title of the presentation is "The Race is On," because we have been running a race. Truthfully, I think the other methods are starting to win, but that's okay. And we're picking U.S. equity portfolios classically and with a quantum annealing computer, the D-Wave. So I'm going to flip the page, and Clark, we're going to hand this over to you after I just give a couple words of what we accomplished. So what we did is we took the Sharpe ratio. So the Sharpe ratio, for those who don't get involved with the stock market too much, that says if I take the expected profit or return from a portfolio and I divide it by the standard deviation of that portfolio, that's a measure of efficiency. Usually it's done after the fact. So I could look at all of my 401ks and mutual funds, I could do a Sharpe ratio, and I can say which ones were good. We decided to do a Sharpe ratio moving forward using existing data from the prior year. We run it on the D-Wave 2000Q, which is a 2048 qubit quantum annealer with what they call the chimera architecture. So it's a 16 by 16 by 4, where each set of qubits it's an 8 qubit set. It talks to just a few other qubits. And so your problems don't scale quite as much. We scaled the problem to 40 assets, thought that was great. We moved it to 60, we moved it to 64. And last night I ran 314. So the reality is we're probably going to get to 1,000 classically, but 64 on the D-Wave. So we use 5 classical solvers and the D-Wave to find efficient portfolios in under a minute at the 60 asset level. We publish portfolios, and what we figured out is at the level of most individual investors or asset managers, you can use either classical methods or quantum annealing computers to build efficient equity portfolios. And, of course, we continue our research. We're still in research mode. So Clark, I'd like you to start and walk through our formulation and then the slides that you put together.
Good evening, everyone. I'm Clark Alexander. I'm the mathematician. I'm the math guy. That's what I am everywhere I go. So if you have math questions, I'm more than happy to answer them. I see a few of my former students out there. Hi, Isla. So what we'll do, I'll keep this at a very, very, very high level without getting too technical in the details. If we have some time and you want some specificity, hit us up in the Q&A and I'll do my best to give you the technical details and we can talk later. So my background is from academic mathematics, mathematical physics, and I even taught quantum computing, and then I moved sort of into data science, machine learning, artificial intelligence, and now I'm sort of back into quantum computing. So I kind of play both of these worlds. So when we're looking at something like the Sharpe ratio, right, this for me is a very attractive thing because it's expectation over standard deviation. Now, if you studied any information theory, that's Fisher space. It's a hyperbolic space. If you're into modern geometry, right, it's bent. And so the reason that we believe that we can give some sort of good prediction based on past data is that standard deviation is in Fisher space and hyperbolic space, it's very expensive to reduce, but it's very cheap to make a bigger standard deviation, right? It's sort of this squared thing in the denominator. So given about a year of data, we expect that we can go out a short amount of time. I mean, there's some stochasticity of how far out we expect the standard deviation to possibly go. So, you know, within a little bit of time, maybe 2 weeks, maybe 3 weeks, maybe 5 weeks if we're like feeling sprite, we'll go 5 weeks out prediction. But the idea is we want to say, okay, what's the best portfolio expectation with some weights, okay? And beta, if you see here, that's the market coefficient divided by the expectation. Now the Sharpe ratio also gets rid of the risk-free stuff. So bonds, you know, you're not really investing efficiently exactly by taking something with 0 standard deviation or close to 0 standard deviation, but you're also not getting a big return. So we take out that because it's sort of a penalty on efficiency. So the problem gets formulated as this. We have a set of stocks and we're doing a buy and hold. And so with the weights, we say that they each cost the same amount of dollars. For the sake of ease, let's call it $1, okay? And so the problem just basically becomes, we have a vector of zeros and ones, and we have some matrix which represents, hopefully, the Sharpe ratio, and we want to do that vector again. So that's a cubo. That's a quadratic form for the number theorists, right? X times Q times X. I want to find the best possible combinations of zeros and ones, and okay, well, that's 2 to the n, right? So already it becomes very, very difficult to do, right? The sort of strange irony is that continuously, there are a lot of efficient algorithms for finding the smallest eigenvector. So discretely is actually much harder, right? And so we originally started with 40 because that is kind of the limit of where we can brute force the solution and actually know. 60 is something else. We actually have to verify classically. Okay, so the Sharpe ratio, you'll notice, is a ratio, and quantum computers don't exactly divide. That's just not the thing they do. So we decided that we could maybe formulate it in a different way. So we have what we call the Chicago quantum ratio. Again, a division, and then we went to the net score. Okay, and so just pointing that, we call them that equation 6. Given some weights and some power alpha, we take variance minus expected return 2 plus alpha. Expected return squared is close to variance, so this alpha sort of shifts us based on basically how big the returns are and how far back we're taking the data. If you're in a big uptrend, okay, then alpha needs to be smaller. If you're in a smaller, slower trend, alpha needs to be a little bit larger just to make the numbers match. For our research, we usually pick 1. That's just empirically how it came out, but there is some wiggle room in there. All right, so that is a nice linear matrix. So let's call that Q, and now we have an XQX, something that we really want to do. Okay, so the question is, you have 2 to the 60 things to look through. How are you going to do that? And the answer is, well, you kind of guess. The answer is you kind of guess. I mean, let's talk Freeman Dyson. How many?
Do you want me to move the slides forward?
Yeah, let's go to the next slide.
We can just go right here.
Okay. So classically, we played with two families of algorithms, Monte Carlo algorithms and genetic algorithms. Okay. So Monte Carlo, some of you will know this, and so if you know this, you know, tune out, go get your cup of coffee or your beer, whatever you're getting, and then come back in 5 minutes. So Monte Carlo, it was described to me a long time ago as like playing darts, right? The first algorithm I ran was throw 1,000,000 darts at a board And those that are within radius 1 versus those that are outside should give you about the area of pi. And it's literally just throwing the darts, okay? So all the Monte Carlo methods are basically that, throwing darts at a dartboard and then sort of taking the average. And how you throw the darts and how you take the average, how you score them, each one of those gives you a sort of variant on Monte Carlo methods. Markov chain, as you know, it's just some Markov process. You just rely on one step back. Okay, so in this case, what we're saying is all the Markov chain Monte Carlo methods look something like this. We have to figure out some way to say this is good or this is bad. For us, it gives us the lowest score or it doesn't. So we guess. And then we guess again, we compare the answers. And the Monte Carlo part is, okay, was that one better? We'll keep going in that direction. Wait, that one wasn't better? Well, how much worse was it? If it's not that much worse, then just explore a little bit and then keep going. And that's Markov chain Monte Carlo. I mean, as condensed as possible. And each one of those little variants, like how much worse is it, right? That's when it's tuned by some temperature parameter, we call that simulated annealing. When you tune it by some quantum tunneling effect, that's quantum annealing, okay? If you're not temperature-based, that's going to be Metropolis or Metropolis Hastings, depending on the symmetry that you're looking for, okay? So generally speaking, we just keep going in the direction that gives us better answers or explore close by if it's not too much worse until we get to a satisfactory answer. And that's the whole of the field in a nutshell. And I know there's a lot more details. And if you want to talk to them, please hit me in the Q&A. I will go into as much detail as you want. Okay, next slide. Okay, now the genetic algorithm kind of has the same feel, but it's something slightly different. Here we're taking the inspiration not from statistical mechanics, but we're taking the inspiration from biology. First thing we have to do is figure out how to score everything. And so this is basically survival of the fittest style algorithm. We get a lot of guesses. You can just guess randomly, okay? And then we score all of them. And then we take two solutions and we're trying to find the best traits of each solution. So these we'll call them parents, and they produce a child solution. And then we score that one. And we have lots of parent combinations scoring and creating lots of children solutions. And then some of them we flip a bit and we call that a mutation. You know, they're X-Men. Sometimes you're too deep in a local minimum and just a bit flip will jump you out of that. Okay, so the algorithm here goes something like this. Make a bunch of guesses, make a bunch of children, make a bunch of mutations, score everything, and then take the few best that you like. Let's say we take the 100 best out of 10,000 potential guesses. And that's a new generation. Then from the new generation, you make more children, make more mutations, guess again. Make more children, make more mutations, guess again. And then you keep going until you have found the fittest possible solution. This is just empirical. If you start with pretty good answers, then you get very, very, very strong elitism showing up quickly. So the way that I like to glue it together is simulate annealer. A simulated annealer gives initial population plus some random guesses, and then you do a genetic algorithm on that. Right? A simulated annealer will give you a pretty good guess. A quantum annealer will give you a very good guess, but there's no guarantee to it. Okay, so to create an initial population, I prefer doing the annealing first and then the genetic algorithm. You know, a few years ago, maybe just last year, we're seeing like the reverse annealing coming up. That kind of glues these things together in the reverse order. And so empirically, I like to do the annealing first and then the genetic algorithm. And so with those two, we actually have a very large set of probabilistic guesses that we can check. And then we can sort of validate how well D-Wave's quantum annealer has done against the classical methods. So we have like a family of stuff versus the quantum annealing. So that's kind of where we have in our validations. Next slide. Yep, okay, and I'll turn this over back to Jeff or to Alex.
So there was a question, and I don't know how to answer it, so let me throw it to the two of you. So what is the quantum computing analog of Turing completeness And how does this relate to quantum annealing versus quantum universal quantum computers?
Okay, I can take that one unless Alex wants to take it. No, okay. Turing completeness. Okay, so in some sense, if we go all the way back to binary logic and we think, in order to compute anything, you need a universal set, right? And in binary logic, that's a NAND gate. A NAND gate will give you a universal computation set. In quantum computing, you need 2 qubits and you need a C0 operator. So you have the Pauli operators, an S, a T gate, and a C0. That doesn't give you every possible unitary state, but it gives you what's called a topologically dense state. Okay, and Ross and Sellinger have done some interesting work on figuring out where the biggest gaps are, but it is topologically dense, so you can get as close as you need. Again, some measurement. So the gate set of Pauli's plus C0 plus TNS is Turing complete in universal quantum computations. How you write those algorithms, totally different story. Annealing is a very specific algorithms. It's almost that D-Wave has baked in the ability to solve a QUBO or a BQM into their chip. So it's a very specific family of problems that it solves, not universal at all. It does one thing like really well. Hope that's a reasonably good answer.
All right, so did we answer the question? All right, so Alex, take it away.
All right, so thank you very much. Thank you all for attending. I hope you can hear me clearly. So Clark is the mathematician, and I am not the mathematician, though I've worked on applied math, and my job has been to take all of this technology and technical stuff and try to make it real, to try to understand how to play with it and how to use it, and how to get somewhere with it. So, it was about September, actually a year ago, that we basically started saying, we are going to solve this problem. And quite frankly, we were starting at zero. So there was a lot of lessons learned. And my goal here is to maybe help those who are attending and those who will listen in the future on some of the stumbling blocks we went through, things that we should have done probably a little better, or things that I've now actually seen others doing that that I advise them on and help them to get through this process faster. And again, what I think we all are trying to do is take a real world problem and find a way to solve it on a quantum computer. We originally started out with IBM Q, and we said, let's solve a financial portfolio optimization problem on a on a gate computer. The chips that we had available to us were obviously only 5 qubits, or I think we had a 16 qubit available as well. And very quickly we realized that in order to go for the target that we were looking for, like 40 assets or so, we would have to go with D-Wave. So I, at that time, did not have a lot of experience with D-Wave, so it was a learning curve for all of us, actually, to understand what is D-Wave and how does it actually solve a problem, and what is this QUBO that everyone talks about, and we have to solve the QUBO before we can solve any problem on D-Wave. So at a high level, here are my thoughts on the steps that one should take when you start looking at a problem and say you want to solve it on a quantum computer, especially a D-Wave. So Jeff, that's really zoomed in. I think I'm losing a little bit of. Okay, that's fine. So so at a high level, you have to understand your classical problem first before moving to building a QUBO. And then you want to fully understand the QUBO and what results you see out of the QUBO before you move into solving that or giving that to D-Wave. As I've consulted with some companies, there's just this kind of like a rush or a desire to take a problem and go straight to a quantum computer. And I think we were kind of guilty of that as well, where there were times when I was saying, you know, where are we really going? I mean, we're getting an answer, but do we know if that answer is correct or not? And it is, I think it's very tempting to go straight from the code that you might be working on to try to run it on a quantum computer. And I've seen a lot of people do that. Or they'll read some research papers on how to build a QUBO, and without really understanding the math, they will say, okay, well, this QUBO model seems to look good. Let me use that one. And D-Wave will give you a result, but you then don't know if that's the right result or not, and what are you really targeting and what are you shooting for. So, so those are 3 steps that, that I will be talking about. And in the end, of course, we want to have some idea of what is the business value that we get out of doing all this work. So we'll talk a little bit about that. All right, Jeff, next slide. And yeah, yep, that's good. Thank you. So with considerable emphasis, I mean, the first thing is to derive your problem classically. A lot of research teams might actually start out with some code. You know, they might have a customer, the customer gives them an application, the application has some code in it, and they say, can you move this to a quantum computer? And then this rush begins of, okay, well, we've got some formulation, classical formulation, now how do we go for D-Wave? So in doing that, one forgets the fact that in order to go to D-Wave, you have to build a QUBO, and that's a mathematical formulation. So you have to understand your classical formulation. And I cannot emphasize it enough, but the teams do have to step back and they have to look at what is it that they're solving in their program, or, you know, what is the objective, and, you know, what are they trying to maximize, or what are they trying to minimize? So in our case, we started out with the Sharpe ratio, and the Sharpe ratio, as Clark showed, is a ratio. It's a division problem, and, you know, that's what we started with. Now, there was this desire to somehow put it on D-Wave, but I mean, we had to kind of step back and say, okay, let's look at what would be the results. We started pulling real-world data. We started looking at, you know, what are the covariance terms in the market? What are, you know, what would be the Sharpe ratios? So actually calculating Sharpe ratios for sample portfolios or sample assets. And we also started putting data onto an Excel spreadsheet. We said, okay, let's put the actual values on an Excel spreadsheet and calculate the Sharpe ratio, you know, classically. So at some point, I mean, we began to understand what is our objective, what is the objective, what is the formulation, and what are we trying to achieve? You know, we were working with a number of assets. So let's say we're working with a universe of 40 assets, and we're trying to figure out what combination of those assets will have the highest Sharpe ratio. So that's our objective, maximizing the Sharpe ratio. So then we validated that, you know, using Excel initially, and then we started doing brute force. I mean, we wanted to know exactly what would be the maximum Sharpe ratio for certain number of assets. Because like I said, I mean, we can give it to D-Wave, and D-Wave can give you some answer. You can have certain assets be 1s and certain assets be 0. But when you accumulate that, you don't know if that's the value you should have got or not. So, you know, finding the best values against live data was very important. So we have some test cases, and we set the target at 40. So initially, my spreadsheet that we put together could only accommodate 16. So we first tried 16, then we expanded and we went to 30, then we went to 40. But in all of those steps, what we were really trying to do was understand our formulation and understand how it behaves and what exactly is happening. We wanted to have the confidence before we start going into D-Wave. So as I mentioned, we use Excel Solver. You can create any kind of a math problem in Excel. We use Solver, which allows you to do Monte Carlo probabilistic solutions. And there's also settings there for evolutionary models. But what we did is we created a grid where we had different assets in it. We allowed the values to be ones or zeros, and we let Monte Carlo then put in ones and zeros randomly and give us the Sharpe ratio. Now, the goal here is to maximize the Sharpe ratio, so we had Solver look for the maximum number in the end. So it would randomly go and find a maximum. Now, typically, Excel will get stuck in a local maximum or a local minimum. So again, we didn't know if that was the best answer or not. Sometimes you would manually switch and look for, could I do better manually? So we would then kind of push Monte Carlo along to have different initial conditions to get to a better answer. During that time, Clark put together our simulator annealer, which obviously very quickly gave us a good answer. And so we were building our tools to get good answers and the best answer, and to be confident on what should be the answer through different methods. Brute force, I mean, we ran a lot of brute force runs where Jeff's PC was always busy running all of the 44 by 40 space to get the absolute best answer. And it was critical because I think we wanted to know what we should receive before we go further.
So let me add something just for color.
Yep.
Not only did we lay it out in Excel at first and do the brute force, but we actually did a step-by-step matrix linear algebra calculator so that we could replicate the exact correct energy levels of the D-Wave, at small enough problem sizes. Let's say it's 16 or 32 stocks, and it would take forever to run. But this way we knew to the level of precision of Python that at least if we had an answer from D-Wave, it was accurate.
And I think some people would think that's waste of time. I don't know. But I really appreciated the fact that we wanted to be sure and we wanted to have the right math. And we wanted to understand our problem before we went further. During that time, Clark was also looking at the simulated bifurcation machine, and we've done some results and tests with that. So basically, the point here is to really understand your problem. Don't just take the code that you're working on and start thinking about what you can do with D-Wave. Understand that problem. Write down the math. I see a lot of teams resisting writing down the math. And there are so many of my engineering paper that I wasted writing down this formulation and how would we convert it into a cubo. And then Jeff was doing the same thing on his end. All right, so we can go to the next. Okay, so assuming that you understand exactly what you're looking for, you have your objective function, you know that you want to either maximize it or minimize it, you know what your good results are. Now is the time to start thinking about a cubo. So what is a cubo? When I got started, I had no idea. And so a cubo is a quadratic, unconstrained binary optimization model or problem. The words actually mean quite a bit. So it's quadratic because it has two variable terms multiplying against each other, like an x and a y, or an x1 and an x2, or in our case, an asset 1 multiplied with asset 2. It is unconstrained in the sense that, and Clark can probably explain this better, it's unconstrained that there's only one way of solving it. You can't really tell the machine to constrain in any way or good look for a certain answer. It will sum and get to the answers on its own. If you do have a constraint on your problem, you have to embed that on the QUBO itself and make it, take away the constraint, put it on the QUBO, so it's still an unconstrained problem. It needs to be binary. So, you know, a lot of problems in the real world are not binary. They're floating point. They have different, you know, you're looking for different values, and you can have values from, you know, 0 to 1 or 0 to any number. And I guess the limitation on the QUBO model is that you have to think of your problem in terms of binary. In other words, you have an asset or you don't have an asset, or you, I've worked on a COVID model as well, where we have to convert the problem into, is a city in lockdown or is a city not in lockdown? Or, so for example, we could have a asset or portfolio optimization problem where we say, you know, how much % of an asset, like how many dollars would you spend on an asset in this optimized problem? Well, the QUBO, the way we have to set it up, you can either have the asset or you don't have the asset. You would have to have a totally different formulation if you are looking for something where you're saying what percentage of an asset would you want, or how many dollars would you want to spend to get an optimized portfolio. So that becomes a totally different problem, and likely it's not possible to solve it using a QUBO.
And it's also easier. There are efficient classical algorithms for solving stuff with a continuous variable, or even to like hundredths. You can project very closely. The QUBO is the difficult one, computationally.
Yep. So I mean, for example, when I was looking at partial differential equations, there was just no way that I could think of. Now there are some papers that do convert partial differential equations into QUBOs. But it's, you know, that is way more complicated for me to figure out. And then the question would be, are you losing a lot when you're trying to do that? I mean, is it even efficient? And then the O is the optimization, which basically says that this QUBO, this matrix, in the end it looks like a matrix, is going to be optimized. It's going to go for the minimum. And so let's go down to the two equations that we have at the bottom. Typically, you will see in a discussion about D-Wave, or if you go to their documentation, you'll see different ways in which a QUBO is represented. We've shown two ways. On the right side is the really short form, where it's basically saying you have a matrix, which is the multiplication. You're multiplying X, which is your set of variables. So let's say if you have 10 assets, you would have X0, X1 to X9. So that's your string of variables, or your variable matrix. XT is the X transpose. It's in the it's the row matrix, and then that's multiplying with Q, and Q is the n by n matrix, which has all of the values. And you know, we'll get into it a little more deeper, but you have, for an n by n matrix, there's diagonal terms and there's the non-diagonal terms. And each of those are being used by this multiplication. And then the X is the same variable. It's just the column vector, or the column matrix. And so you're multiplying XT by Q and by X. Now, if you do that multiplication, if you actually write it down with linear algebra, you will find that it has one value. And it's the sum of all of those Q values, depending on whether the X value was 0 or 1. So if the X was, let's say X1 was 1, then it will end up multiplying and using certain of those Q values. It'll use the Q value on the diagonal and then some on the non-diagonal. But in the end, you get a value, it's a sum. And the whole point of the QBO is to find the minimum. You're finding the minimum value by selecting different combinations of X values. So that's basically, that is like a shorthand that is technically explains the whole QBO. Now, the one on the left is expanded out a little bit more, so you can begin to understand it, how to implement it in code. So the Q matrix, basically, you're putting down all, it's this two-dimensional matrix, and for each term in the matrix, you would say that's term Qij. And you start from the top left and you continue forward, you got an I term and J term. When I and J are equal, you're on the diagonal. So if you have Q11 or Q22 or Q33, those are the diagonal terms on the matrix. Those are also called the linear terms. Those are also the biases that go onto the qubits. When I and J are not equal, for example, Q12 or Q23, those are the non-linear terms or the non-diagonal terms. And those are the couplings that go onto D-Wave. So what you're basically seeing over here is that if you look at the Xi and Xj terms that are being multiplied, your Xi can either be 0 or 1. So it's defined over there. Xi in the set is either 0 or 1. So when you let's say Xi is 0, it'll make the whole thing 0. Or when any X value is 0, the whole thing is 0. When any X value is 1, then you will take in your Qij values. So basically, you end up summing through the Qij terms depending on which assets or which cities or which objects you have on, which is 1, and you ignore the ones that you don't want, which you have off or you don't select, those are 0. And by looking at different combinations, you get a sum. You get a sum for each of those combinations. And what D-Wave technically does is it will find the lowest energy after trying all of these combinations using quantum annealing or the quantum process. If you use a simulated annealer, it does the same thing, only using simulated annealing or like a heat evolution, energy evolution using heat to evolve the different combinations of X. So if you think about it, you might have a very complicated problem. In the end, you have to convert it into this form, into this QBO form. It has to be binary. It has these linear terms, which are the biases on the qubits, and it has these coupling terms, the non-diagonal terms, which are the couplings on the qubits. And so your whole formulation has to somehow fit into this model, and that's what D-Wave will use. D-Wave doesn't do anything else. It does not allow you, it's like a calculator that does one thing. And if you cannot fit your problem into this QBO, you cannot give it to D-Wave. Now, if you notice, there's no room over here to do multiplications or divisions. If you cannot take your formulation and change it from multiplications and divisions into an addition problem, because this is really an addition, you're adding up all of your Qi terms in a binary fashion. If you cannot do that, you're not converting it into a QBO. So that's the limitation. I mean, I think of it as a bottleneck. I mean, you're taking sometimes very complicated equations and then you have to convert them into a QBO. And the question you have to ask is, are you losing precision? Are you losing information when you start doing that?
So Alex, let me ask that we pick up the pace a little bit because
All
we're
right.
almost through an hour.
Oh, wow. Okay.
Yep.
So, all right. I think we should then just go to the next slide.
I mean, it's great. It's a lot of detail. So this is, and I
It
know you
is.
love these pictures. So
Okay. So we talked about the cubo itself, but we're trying to maximize or minimize our problem, trying to find the maximum minimum. And when you build a cubo, there's no way to visualize what is this cubo. You've got a matrix, and you don't know what kind of results will come out of it. So the emphasis here is to try to understand the cubo classically and to solve it classically or visualize it classically. So what we're doing here is the blue plot. So on the right side, the blue plot is what our original cubo looks like. And if you look at it, it has a minimum kind of on the left side. So on the right side, you have no assets. On the left side, you have all assets. So if you were to send this cubo to D-Wave or to any simulated annealer or genetic algorithm, you will get all assets as your answer. You will get all ones. And that's not what we're looking for. We're not looking for all ones. Now, sometimes your cubo could be in a way where the tip, the blue tip, rather than being at the bottom, is up on the top. So when you send it to D-Wave and it minimizes, your minimum is at 0, which is no assets. So D-Wave will say zeros generally as the best answer. So what we have to do, typically there's a penalty or a constraint or something that's put on the cubo that really solves your problem and brings the minimum of this landscape to where your minimum should be. And so our minimum, so what we're doing here is where you see the red shading, that's where we are looking for a certain number of assets in our solution. So even if we have 40 assets or 65 assets as the starting point, we're saying, what's the best solution at 10 assets? The lower plot is, let's say, about 40 assets. So we are actually doing a transformation on the cubo. We're putting constraints on it. You could call it a penalty or a transformation. And we are shifting the values in such a way that the values we want are at the bottom. They're the minimum that D-Wave can find. All right, so I think we'll end with that over there. So evaluating the efficiency. So I think I can talk about this in the next slide.
all right, sounds good.
Try to keep moving forward. Otherwise, we keep talking all night.
No, and it's fun. I just want to make sure people have a chance to ask questions and such.
Can you send your questions?
And by the way, it looks like Itamar Halavi. If you can ask your question in the Q&A chat, then we can all see it and make sure we answer it.
Okay. So step 3.
I'm trying to get to the Q&As as they come in. So
okay.
Keep going, Alex.
All right. So after you understand your classical formulation, you've built your cubo and you understand the results you're going to get from the cubo. You found a way to visualize your cubo. You know where your minimums are. You know that it's working. Then we believe that it's time to give it to D-Wave, because D-Wave already has other things that other wrenches it's going to throw into the equation. It's going to, we're dealing with the fact that our 40 asset problem or 60 asset problem doesn't use 60 qubits or 40 qubits. It ends up spreading those qubits. It ends up spreading those assets onto multiple qubits because, as Jeff mentioned, there aren't enough connections between the qubits. So there is an embedding function in D-Wave that takes your formulation and spreads it onto the chimera or onto the chip. The number of samples that we ask D-Wave to do determines probabilistically whether we're going to see the right answer or not. The more sampling you do, the better the probability, the higher the chance that you're going to see the right answer. But you're not always going to see the right answer. And Even if you have brought your minimum down, there might still be other solutions that do end up being lower. So DWIV will find all kinds of answers. And this is why it's important to know what you're looking for and to know whether you're right or not, because you're going to get probabilistic answers and you have to be able to pick out what's correct and what's not correct. Other parameters in D-Wave are the annealing time and the chain strength. So as we said, one asset is spread over multiple qubits. If you solve, when you solve the problem, D-Wave checks to see whether one of those assets that was spread on multiple qubits retained its value. So if it was 1, then all of those qubits should be 1. If it was 0, all of those qubits should be 0. But if some are 1 and some are 0, obviously the integrity is lost. And so those are called chain breaks. So as the problem scales, you get these long chains. One asset can be spread among 20 or 30 qubits. And what we have seen is that by the time you get to 64 assets, especially in our formulation where every asset is connected to another asset, because of the coupling terms or the covariance terms, D-Wave can only accommodate 64 assets, and it uses up all of the 2041 qubits to accommodate 64 assets.
Yeah, let me just add a little bit of color to that. So 2048 qubits, 2 times 16 times 16 times 4 is kind of the math in the D-Wave documentation, and that allows you to have as much as 65 fully connected vertices or cliches or stocks. And so 65, but we took it down to 64 because it runs probably 90% of the time 64 assets. The chain break. So we have a video on the D-Wave inspector because it's really interesting to see 33 qubits required to keep track of one stock. And in other cases, maybe it's 6. And so there's some settings that we've learned where you can have D-Wave make them all equal. So all the chain lengths are equivalent, which allows you to get a little bit longer time before decoherence, which is helpful. The annealing time is interesting because we learned about this with our bespoke simulated annealer and the D-Wave simulated annealer. So you can tell it to take a long time to look for really, really nice minimum across like the whole landscape before the temperature, basically, like, think of it, you might have 500 or 1,000 notches of temperature. And so, a short annealing time, maybe 20 microseconds, is good for certain asset sizes. We've gone as high as 200 microseconds. And in fact, you can go to 2,000 microseconds of annealing time. And so depending on how deep you need to go, you can affect the annealing time. And then the last thing, I don't know if it's clear to everyone. So let's say we're doing 64 assets. We're sending a 64 by 64 by 64 matrix to D-Wave, and we're peeling them off one at a time. And we do that because the weights. So if it's going to be $1 a stock, that's easy, right? If I have 2 stocks, I have $2. I have 3 stocks, I have $3. But no, we didn't make it that easy. You have $100 to invest. If it's 2 stocks, it's $50 each. If it's 10 stocks, it's $10 each. Therefore, because each of us only has $100 or 100% to invest, we have to apply the weighting directly to the qubits, the expected returns, the linear terms. And so our model may be a little different than others, but we like to have, one solid QUBO for each portfolio size. And so I just didn't know if that was clear to everyone.
Yeah, and I think there's an advantage to that because, and we'll talk about that in the value that we get out of this. But so
Yep.
then at that point we're running it on D-Wave, where we're getting values, we understand what value we should get, and there's an opportunity to try out different other tools like the Fujitsu Digital Annealer and the Toshiba Simulated Bifurcation Machine, or D-Wave also has a hybrid annealer, which we have looked at. And the Taboo sampler, QC Forge has a modified version of an annealer. They use D-Wave, but they claim that it's faster and better. And then ATOS has also a quantum learning machine. So there are other ways of solving this problem and comparing results between D-Wave and these other tools. And again, the classical ones we'd already done, so we're obviously comparing against the classical as well.
So let me be transparent because, we are Chicago Quantum. We have an NDA with Fujitsu. We have an NDA with Atos. We are in conversations to be allowed to use their equipment. For Toshiba, we don't need an NDA. You just need $3.06 per hour because it's available on AWS. So with Clark and Alex's help, I'm trying to figure out how to take our Cubo and run it on the Toshiba system, which seems amazingly fast, which is great. And D-Wave is nice because, oh, by the way, Alex, I'm going to do one more shot on the hybrid annealer because my time runs out on the 11th. So I've decided to blow my whole minute on the hybrid sampler. Here's the deal. The quantum annealer only runs 64 assets, but we have 314 sitting in my memory right now. And by the way, I have 3,200 stocks I'm dying to run at one time, right? 2 to the 3,200 is a pretty big Hilbert space. And if the hybrid annealer could give us an answer, wow, I just want to know, right? So.
Yep. So
all right, back to you, Alex.
Yeah. So for the listeners, the hybrid annealer actually allows us to put in more than 65 assets, and D-Wave has created that tool so that someone can go beyond the limit of 65 by 65 and put in more values, and then they, through their algorithm, which to us is kind of a black box, they leverage the quantum chip with the classical formulation that they have and give back a result. And I think, unfortunately, we only get one result back. So, and that has not been at the number of assets we want. So to our formulation, it's not the right answer. But in some cases, it could be the right answer.
Yep.
All right. So
let's continue because I want to get to the last part of it.
Okay, so really quickly here. So after going through all these different steps, I think it is important to look at, did someone get value out of running their problem on D-Wave, converting it to a Cubo, doing all this extra calculation, going through this, to me, like a bottleneck, going through this bottleneck and then doing an optimization. Is there value? I believe there are some problems, and especially the financial portfolio optimization, which to some extent fits a Cubo much better than I think other problems would. And because on the stock market, stocks move, in a certain pattern with each other, which is found by using the covariance term. That is almost, that's like the covariance term that is on the Cubo. So it fits, and there we were able to convert it into an addition problem. So we were able to use that. Some problems might not. There are situations where by the time you do all the processing to build the Cubo, you probably already know your maximum or your minimum. There are examples of going to different paths on a map, on a graph. You're looking for different shortest paths, and if you had to calculate all the paths to put on the Cubo, by then you already know what the shortest path is. So is it really worth using a Cubo and going to D-Wave? So I think here it is important for the teams to really look at and see what are the benefits they're getting out of building the Cubo and the solutions that are coming from a probabilistic quantum solver. Now, we believe that finding the best answer or the highest Sharpe ratio or the best the lowest CQNS score is great. I mean, that's a good challenge. But in reality, when someone's wanting a portfolio, they're not just going to pick 2 stocks for a portfolio. They're going to want a portfolio of 5 stocks or a portfolio of 10 stocks. In that case, D-Wave is excellent in finding a whole range of really good answers, and we can focus it on the answers we want, on 5 assets or 6 assets or 7 assets. And it will give us, and it always minimizes, so it will give us the best or really good answers in those number of assets, which I think is a really valuable byproduct, I guess, coming out of D-Wave, and definitely I think of value to us. Any other points on that, Jeff? Because then we can continue into the next slide, and you can probably skip the next slide and go into your presentation.
Okay. I guess just in the spirit of full transparency and not overselling or overhyping, it's very important because there should be no hype in this presentation. The key to using the quantum annealer in this case was we created a horse race up to 64 assets. We actually didn't know 64 was the maximum. And so at 64 assets, you can solve the problem in under a minute classically or with the quantum annealer. And it's fine. It works great. So if we were to go to a client and try to solve a problem that had 64 variables and they wanted a solution in under a minute, and they wanted to see whether the quantum computer, as Alex had said, gives like a richness of answers, a set of answers that's all in the ballpark satisfactory. Or you know what, guys, just do it the old-fashioned way. Just give me a simulated annealer feeding into a genetic algorithm. Give me a Monte Carlo fat tail in the back. Now I got 2, and you know what? I don't need this quantum. Great. So let's be honest. If you're paying for consulting and we're $200 an hour, it's going to be 100 hours. Whether we use a quantum computer and charge you an extra, I don't know, couple of $100, you might want that answer to be thrown into the pot to give you like a more of a richness of an answer. We're never saying that the quantum annealer, in this experiment that we've done, we're never saying that it is superior or supreme or whatever the right term is. What we're saying is that there's a little pixie dust. There seems to be a quantum effect that's giving us amazing values in a small sample set. And I just want to go back to a chart we skipped over because I think there's some value. So this chart, and I'm going to zoom in because I'm pretty sure nobody understands this without an explanation. So we had the D-wave. So the shape, you're probably familiar with it, is the Sharpe ratio efficient frontier. So it says on the bottom is the standard deviation, on the top is the expected return. For any given point of standard deviation, what's the maximum expected return I can receive? And that's the efficient frontier. And so if you look here all the way to the left, we had 2 portfolios chosen by a quantum computer. This was like a throwaway. Just give me 2, right? By the way, we compared it to 115,000 shots of a Markov, Monte Carlo. And they're really close to the efficient frontier. In fact, the genetic algorithm is the best answer, and that's right up here. So 2 against 115,000. When we ran 30, we were calibrating the system. This wasn't real answers. I mean, they're real data, but we weren't looking to like invest based on this. And you look at 30 and they're right on the efficient frontier. It's crazy. It's like it's guessing really well. Then you look here, blue is the efficient frontier, black is quantum, and the black actually exceeds the efficient frontier. That's 150. Now, 150 compared to 20,000, you could say it's not fair. Monte Carlo needs more. So we do 414 against 40,000, and we're blowing away the efficient frontier at the higher risk portfolios. And then on and on and on, different data sets. This is 2,600 versus 221,000, 3,600 versus 50,000. And you see red overwhelming the blue. So the point is that whatever the quantum effect is, it's allowing the D wave to give us really good sharp ratios, even though what we're using is the Chicago quantum net score. And that was when we realized we were onto something interesting. So that's kind of the pictorial of what the value is. So, all right. So per Alex's suggestion, I'm gonna go past the what did we accomplish slide, and I'm gonna move on to our initial analysis. So this is the results from our second paper, the 60 stock problem. And again, I'll remind people, please, please, please ask questions. Make comments, make chats. I love the questions. That makes it so much more fun, actually. So again, this is from the paper. So we had 6 methods that solved the 60 stock problem in under a minute. And in pretty much every case, they found what we determined to be the ideal portfolio, the best CQNS out of 60 stocks that we can find. And we're using non-proprietary methods out of Python and D-Wave. And so what we found on the lower left, genetic algorithm found it in 7 seconds. The D-Wave simulated an annealer in 11 seconds. The bespoke simulated annealer, the one that we wrote, was 15. A quantum annealer took 21 seconds. That included calibration time. If you take out the setup, it's probably about 15 seconds of runtime. The fat-tailed Monte Carlo, which is a set of both N over 2 and fat-tailed, ran 222,000 samples, took 24 seconds. And then we fed the genetic algorithm the D-Wave answers, and I think there was a memory issue because it took 48 seconds. We went back the next day and reran that data set, and it took 6 seconds. So we ended up at 60 stocks having really fast success. The Taboo sampler, we can't seem to get anything better than random out of it. And the D-Wave hybrid sampler, we're still not finding valid portfolios. So, and again, this is using the Chicago quantum net score, which is variance minus return, raised to the 2 plus alpha. In this case, alpha was set equal to 1. In the spirit of disclosure, with the markets jumping up, I've had to take alpha to 2. So our latest experiment, alpha's 2 now. And so, yeah, we're finding very, very good, solid answers within a minute. And fairly consistently with the 60 asset paper. What's interesting is we didn't actually find that many stocks. We found these 2 tried and trues, right? Ameriprise and Apache, a mid-tier investment house and an oil development company, a producer of oil and gas. And that's it. And when you look at the stocks, what happens is they move in such a way that they cancel out each other's failures. They go up. They don't seem to go down very often, if you hold them as a pair, equal weighted. So that's great. We publish it. I'll tell you that I put a paper out on Medium, not an academic paper, just like a easy paper. 314 assets. And the models are finding between 3 and 156 assets. Our best solution had 40 assets. So I think there's a factor here of these 2 stocks were so good that they overwhelmed the other stocks. As we're running larger and larger samples, we're getting larger and larger portfolios, but we still see a pull away of really great Chicago quantum net scores versus all the rest. And so that's what we found here. So there's an interpretation as well. Our model is picking high beta stocks that have the potential to run with the market with heavily offsetting covariance terms. So if I had to describe it, we built a model that looks for the pattern behind the trading data. So high beta, lots of money when the market goes up, and the covariance is offset, so I have very low variance or volatility expected, assuming that they trade the same way moving forward. So just to keep us honest, we publish all of our results. We like to do that because it's research. We're not investing in these stocks yet. And so, and if somebody were to pay us to pick stocks, we would say this is not investment advice. But so the market test after 5 weeks was our ideal 2-stock portfolio delivered 14% returns in the market. The benchmarks did about 6 or 7. And it outperformed in 2 weeks and it outperformed in 5 weeks because it avoided a large drop that the market had taken during that time. And then, so what's happening is we have to do a few things to the model. And this is for those who might be involved in trading. We set floors and ceilings on the market indices because what was happening was the NASDAQ went up like 48% in the past year during the measurement period. And you don't want to assume even a quarter of our market indices going up 48% next year. It's not realistic. So we set a floor, let's say, of 2.5%, because we're not expecting the stock market to drop or to return less than 2.5%. And maybe we do a ceiling of 17.5%. So, you start to moderate a little bit. And so we're publishing this. We continue to produce portfolios. By the way, if you want, you can send us stocks, and we can have a conversation about looking at stocks that you're interested in and running them through our model. I want to share some technical details that were fun that we learned a lot about. So the number one scale challenge to get to 64 stocks and have it work great was our linear and our quadratic terms. They really do need to be rich enough, create an energy landscape that is diverse enough that we can find a local minimum and we don't just slide down to all ones or all zeros. Oh, and by the way, it can deal with regime change. I'll take that in a fun, I love that question, by the way. Thank you. So when the market goes up a lot, like 10% in a week or something, or 2 weeks, we've had some crazy raises recently. Just look at the math. The variance minus expected return raised to a power. If I let the expected returns go up and not affect the power, my variance becomes irrelevant and I just pick my high beta stocks. I could actually play with the power, maybe take it down to a 1, and this thing will only take 1 stock portfolios. If I took the power to 5, 6, 7, 8, 9, I can get a lot of stocks. So what you want to do is have the variance and the expected returns to be somewhat equivalent. So I'm playing with the balance of risk and return. So I would say if the market were to change, I don't know whether it goes up or down in a regime change, but we would watch. And so you're not really affecting the covariance. You're just worried about the balance between variance and expected return. So getting back to your energy landscape, if you look at these quadratic terms, 0.004, 0.003, and you compare that to your linear terms, which in this case actually were set to a min-max of negative 0.9, there's a lot of difference. And the reason is that 59 stocks or 64 stocks, there's a lot of covariance terms to add up. And so they're, by just the math, they're very small. And so when you first look at this heat map, it's purple or it's dark green, that the quadratic and linear terms are about the same. It finds really rich, great results, and it finds them often. Well, when you're in the higher end of the range, the quadratic terms are so small that D-Wave has trouble kind of finding and holding on to those local minimum. The second is, and this is when we did 60 assets and we didn't know the level was 64, we would actually plot the qubits that were holding the data for each stock. You draw this little yellow line, and what happens is you start to see that this line could be as many as 40 qubits to hold the data for one stock. The whole map, you see these little circles with 8 dots in them. Those are the chimera cells for the D-Wave. And so that's what's interesting, right? So those hold data and the connectors are in between them. And so we really fill up all of the qubits at 60 stocks. And so at 64 stocks, we really are at the maximum. So hopefully you guys are answering. I'll just say we answered that first one live. So let's keep going. So the connectivity issue, 64 assets, unless we use things like fixed embedding composite from D-Wave or lazy, I love that name, lazy embedding composite, and we do what we always do, which is embedding composite, we could end up with some crazy chain links. And so we have to kind of walk that fine line as we scale. We did not have that problem at 16 assets, but we do at 64. The next is, what does a 64 asset embedding look like? That's what it looks like, right on the slide. It's every single asset has the number of the qubit that it connects to. So just to pick an example over here, you see 7. So 7 is connected to qubit 151 and 143 and 139, da 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 da. And so it's a lot, like a 1419 and 1547 and 1931. So it's having to keep track of the data on all of those qubits. And so we now know we can find up to a 64 Cleach embedding, fully connected vertices. We pray that D-Wave will let us use the new 5000, or what they call the D-Wave Advantage, because it's over 5,000 qubits and there's a lot more connectivity. So I can't even predict how many stocks I can put on it, but if we could put 300-400 on it, now we're really talking some business here. There is no workaround to the 65 stock theoretical maximum. And so we're done trying to get more assets to run on the quantum annealer. And like I said, last night we did 314 assets. One of the models took a minute. One of the models took like 2.5 minutes. One took an hour, right? So it's there's work. The engineering accomplishment, remember how we showed you the affine transformation with the different curves and how we pulled up the curve so that the minimum energy value was right where we wanted it? Well, this is another representation of that data. So the portfolio size is the y-axis. The orange is what we want. You want the blue, which is what we actually found, to be up and down above the orange, so that if we're asking for 30 stocks right here, that we get some that are 25, some that are 35, and you get the answer in the middle. Unfortunately, you look at that 30, you have to go down a really long way to get something like 24. There were no answers that were valid. So once we switched and we did the affine transformation here at 30 assets, you see a nice rich set of blue dots above and below. Here, you could see from 20 to 40 assets, lots of assets above and below. And by the way, underneath and behind the orange as well. And so this is what makes this important, is we have to look at the kind of engineering challenges as we run for a client. And so if a client were to give us a bond question, a fixed income, I would expect the QUBO to be different, the data source to be different, the affine transformations to be different. But at the end of the day, it's a step-by-step problem to get a quantum answer. We talked about energy landscape, and this was another one. The first time we ran it, we just did like 100 million Monte Carlo runs. And so the problem was we weren't getting really good answers. We were just making my server, which is over there, really hot. It was awesome because it was winter. And so it really like helped with the heating bill. Oh, wait, it made the heating bill go up because it's a server. So what we figured out is we could run just a couple of assets across. So right now, like for the 300 stock one, I do 6,000 hits at every asset size. A portfolio has 1 asset. A portfolio has 2 assets. So give me 6,000. I do 1 million up front just to load it. And what we find is that these little like strings that come down are actually your optimal portfolio found at those asset sizes. And so small portfolio, remember Ameriprise and Apache, they were right here. Plus there was one that was a little bigger. And you see these little things coming down. So if you could get something in this range, you could really make money. Now, by the way, I don't show you the top of the chart. The CQNS scores for some of the small portfolios are so horrendously terrible that you might as well throw your money in a shredder, because you really could make a mistake if you randomly pick 2 stocks or 3 stocks to invest in. What happens is if you pick 60 stocks to invest in, you really can't make them, or 50 or 40, because the best isn't that great. The worst isn't that great. I mean, you could get bad luck, but pretty much diversification works if you don't have a point of view. But if you have a point of view, you want to get this little portfolio here and you just want to make a ton of money at it and then go back in a month and do it again. This Monte Carlo fat-tailed approach allowed us to visualize the energy landscape and focus our efforts. This was a big deal. This got us from 40 to 60 assets. And this is some of the structure of the energy landscape. The one over to the right, lowers better. So you can see with a certain, when we just ran the Monte Carlo around the discrete N over 2, you can see everything is like in this tight range. You're not going to find anything. You could do 1 billion of those. You're not going to find a really great answer. But take a look. We found some really good energy values for small portfolios. That's about 6 or 7 right there. But look at how terrible you could be as well. So what it says is there's a lot of range of value that you could produce by just finding 50 of those good portfolios and maybe find 1 or 2 of the best ones and put your money in it. This is different than the Sharpe ratio. This is an unexpected benefit of linearizing our model. If you look here, the Sharpe ratio maximum is better. So you run your Monte Carlo and you're just as likely to find a really good Sharpe ratio as a pretty good Sharpe ratio. There's no bad Sharpe ratios. And then you look here at all the different portfolio sizes. Small portfolios almost never have a good Sharpe ratio. And then it's kind of the same. Really big ones also don't. So there's not a lot of money to be made. And when I've talked to the investment houses, I even talked to Google about this. They're like, Sharpe ratio, we don't like it. We don't want it. There's no money to be made. There's nothing there. There's no like finding the lucky string. But if you come down here, you could find that minimum value, and that's worth money. And this only takes 1 million runs to be able to see this type of value. And so I think that's important, right? When you pick your problem, I have a buddy of mine that's looking for insurance. He's doing insurance umbrella rating. Well, they might look at like claims that they had and find a rating engine for different policies. And if you could find one that really makes you a ton of money, that's great. If you could run it on a quantum computer and it runs in 1 second, even better. By the way, it doesn't have to be perfect. If it runs in 1 second, then I want to buy a claim or I want to buy a policy, run it. Oops, got a red flag, run it on the quantum computer. Take that extra 2 seconds. Boom, here's your price. It's $9 a month. So here's our research artifacts. I have a question, Itamar, and I'm not sure I understand it. Connect to volatility. Can you add another sentence to that, please? Because I want to answer it. So our research artifacts, we have a 40 stock archive article. We have 4 blog articles in Medium. Actually, now we have like 6. And then we have our 60 stock in archive. We publish everything to ResearchGate. We're in Google Scholar. In fact, we were told by the folks that we cited in the early paper, you do, I know Dr. Du from, she's from University of Denver. We're going to be meeting with the team, by the way, this coming week. And they're going to give us a citation. And you can go to the website and see just tons of public citations. And I'll answer the question while I leave up our 2020 goals. So to the extent I understand your question, temperature annealing connected to volatility. So I explained this in one of my videos. I'm not a physicist, right? But I kind of have an idea of how this works. So imagine when it's hot and I can look across the broad landscape, 1 stock, 2 stocks, all the way to 314 stocks. And it's hot, I'm jumping around, I'm looking for a good area to try to find a local minimum. And as long as the temperature's hot, I jump a lot. Sometimes I jump when the answer's worse, just to try out a different area. But as the temperature cools, I jump less and less and less. And so it's not so much connected to volatility, it's connected to the difference or the net between volatility and expected return. And so I'm looking for the deepest satisfactory solution, volatility minus expected return, across that landscape. And to be honest, at 314 assets, we're looking at, I think it's 3 times 10 to the 94 Hilbert space. And we're finding really good answers in 1.5 minutes, 2 minutes by jumping around like that, right? So that's when we talk about temperature annealing. So, okay, so what's our goal? Our goal is to mature and expand our portfolio optimization model and application. We want it to be good enough that we get the call from a Goldman Sachs. But we also want it to be good enough that we get a call from what I call widows and orphans. Someone who's got $1,000 or $2,000 they want to invest, and they just want to not spend very much money, but they want to have us take a look at what they're thinking. We're also looking at adding different asset types, adding back testing, independent portfolio tiling. And truthfully, we want to find that maximum classical stock universe. There are 3,200 stocks listed today, according to NASDAQ, on the New York Stock Exchange and the NASDAQ Q. Those are your largest, most liquid assets. Those are the ones without the accounting irregularities. And we want to run them all the US stocks. And we're also going to look at shorter duration investment horizons, because maybe there is something here where we can have a 15-minute strategy for someone. We are evaluating right now quantum walks on graphs. Our hypothesis is it can add value in financial service applications. And we'd like to earn revenues by serving clients, grow the team, and building our capabilities. We are recruiting volunteers, and as clients come in, we're going to be recruiting paid associates. So please give us a call if you're interested in trying to basically beat the stock market. Thank you very much. Let me open it up for questions. Thank you, guys. And Deb, or one of the other hosts, let's turn on the microphones so that people can talk.
Well, I have to ask Kamala. You have to wait a minute for that. Thank you.
Okay.
In the meantime, keep going to the Q&A.
Yes.
Yeah. There. Well, there really isn't. We answered the regime change, which is basically floors, ceilings, and power, CQNS power rate. And I think we answered we answered live on the temperature annealing connected to volatility. So. Well, let me ask you this. So Clark and Alex, any questions that they should have asked us that they didn't?
I'm sure there's a lot of questions.
That's the tougher question, right? That's the tougher question.
Yeah.
Right.
I will say that, it's taken us a year to figure out all of these details. And to some extent, this must be overwhelming because there's a lot of technical details. It took us a long time to understand that we needed to visualize the landscape. Otherwise, you're just kind of groping in the dark. You don't really know what you're getting, why you're getting it. And I will also add that, there's a lot of good papers out there of solid work with the math in converting it to a cubo, and
Yeah.
there's some very impressive formulations out there that can be very similar to what we've done. And in different types of cubo formulations, the different types of real world problems, people have different formulations. Like you can use something like a knapsack problem, or a max cut type of a problem. So there are samples or examples of how to convert a problem into a cubo. Those might not always fit your problem, but those are good starting points to begin to think about this.
Also, give a call out. Anyone who wants to connect on LinkedIn or chat about these things, very interesting. I already hit another Northwestern math PhD, so that was cool. Also, if anyone has experience in simulated bifurcation machines, I would like to talk to you. I coded up several, and I just couldn't get them to deliver the deep minimums that are promised in the academic paper. So they're not included here in our work because they didn't produce the results that we had expected. And they are fast. They're definitely fast, but that's, as we all know, that's only one of several measurements that we take in computing. Time, accuracy, energy efficiency, memory storage. All of these are important measurements now. Any other technical questions I'm happy to take.
Oh, we have a question from Sandeep Patil. So Alex, he'd like you to answer it.
Is he asking Clark or me?
You.
No, Alex, he's answering you.
Let's see. Great question. I mentioned that you're looking for volunteers. So, I think to some extent.
Oh no, for Jeff.
Nope, for Jeff.
Yep.
All right.
And Itamar, what do you mean by detail bifurcation machine?
I just sent him the definition of it, but if you grab it under answered.
Got it, okay.
Yeah, so probably the best way to answer this is to give you Jeffrey at quantum-usaci.com. And so I'll tell you what so we just picked up 2 volunteers this week. They don't want to be paid. They just want to research. They, like, as an example, they might want to work on the simulated bifurcation, or they might want to help me scale to 2,000 assets. They might have a laptop that they want to burn out the fans on, right? But they're enjoying it, right? And so they're like, let me get on the team. So we would ask them to verbally agree to an NDA. Please don't take the ideas that we have and share them, but contribute. Get on our Slack channel. Maybe drive some code. And what happens then is, hey, while you're at it, why don't we put your name on all of our research papers because you're helping us write them now. We're giving a speech at the D-Wave conference or at the International Quantum Tech Conference. Why don't you have a speaking role? And so researcher means unpaid. Associate means paid. So what that means is it's the same thing. Join the team, jump on in, get involved. But then if we take in a client engagement, my belief for Chicago Quantum is we should pay the people who do the work. So imagine if we had a project and Sandeep, you did 50% of the labor with whatever overhead I need to take off the top for taxes and fees and whatever, you get the 50% that you earned. And so hopefully we charge a lot of money per hour and you get a lot of money out of it. But we're not looking to get rich as a company based on other people's work, right? I'm going to bill as well. That's why I'm going to earn a living. And the idea is that we're a consultancy. So we want to solve problems for clients. And my goal is to have 50 associates producing fees and revenue, serving clients, building references. And so it all starts with saying, I'll be an associate, which means you get to refuse or accept consulting assignments, and you get to be on our Friday calls and actually help us push the science forward. And if we got NSF funding as well, we still have a grant outstanding. You know, you might get grant money as well. So did I answer your question, Sandeep? Yes. Okay, great. All right.
So Jeff, this is Vikas, right? I'm one of the hosts. So if I ask this, right, and you ran this, you did this on quantum annealing, was some part or any part of it tried on classical computer, and what kind of performance, did we see when compared with classical computers?
So I have that answer for you. So right here. So yes, we ran it on classical. We ran it on my 2013 Macintosh with 16 gig of RAM at 1600 megahertz. And that gave us 7 seconds for classical, you know, a genetic algorithm. By the way, that Clark helped me, but I coded it. It's about 1.5 pages of code. It is not optimum. I'm not a programmer. Our bespoke simulated annealer took 15 seconds. The D-Wave took 21 seconds. And that's because we added up all the time for all the runs, including all the calibration runs. We've gotten that down to 1 second. We expect, if we're doing a full-blown research paper, to spend about 15 seconds of compute time. And so Monte Carlo always takes longer, 24 seconds. 314 assets, it's almost 10 minutes to run the Monte Carlo. To the extent, if we could run it on the D-Wave, it would still be 20 microseconds or 100 microseconds, you know, per run added up. And so this is how you would compare it. And these were all coming up with roughly the same quality of answer.
Yeah.
Did that answer your question?
It does. It does.
It might be time for a new Mac. If I'm doing 3,000 assets, I worry that I could be waiting an hour, right?
Yeah, I have a 32 gig RAM machine, and I did 10,000 assets. And just to get one like quick simulated annealer run, it took about 47 minutes.
Right.
But 10,000 assets, not bad.
Yeah. So keep going with your question, though. So the way to think of it, I think, is this. I don't think we would ever go to a client and say, just trust the quantum annealer. You wouldn't do that. So of course we're going to run like genetic algorithm and simulated annealer, and of course we're probably going to take the D-Wave answers and shove them back into the genetic algorithm, because it doesn't cost you anything, right?
Yeah, the correct answer generally is you take as many methods as you can and you make them compete.
Yes.
So you take the D-Wave solutions and a classical simulated annealer, and I have also run bifurcation machines, and I run them all through a genetic algorithm, which refuses to give anything worse than its initial population. That always does better because I require it to. It takes longer, but in terms of like quality of solution, it almost always gives the best or close to the best known classical solution.
Yep. We have a good question here. Thank you, Robert. Can you do hybrid algorithms where you alter the QUBO during execution?
I mean, something like a time-based QUBO?
Well, I don't know. Why don't you go first then, Clark, if you have an idea? Because I was just going to say, based on calculations. Well, that's interesting, because that basically just says iterate, right? Like you could run D-Wave. So the real answer is yes. What you would do is you'd run D-Wave, you'd see what answers you have, and then you could actually reverse anneal from those answers and get an even better answer. That was something that David Venturelli and Kondratev did about 4 years ago. And they were the first ones to do the reverse annealing. So yes, you can of course do reverse annealing, iterates, great. The second way would be basically do your cubos based on where you think the best answer is. And so I'll tell you what that could look like. And I've done it kind of on when we have an interesting day, let's say. Let me go down to the chart, the interesting data chart. So right here. So if you really believed Monte Carlo that all your answers were, let's say, 10 assets or left, you would just run D-Wave 10 assets or left or less. You still can't change the cubo. And we didn't really document what's in the cubo. So let me just use words. The cubo contains both sides of the equation. It contains both the profit and the risk. So you would never actually want to change it because it's a year's worth of data. What you do is you could change where the D-Wave looks. Alex in the beginning used to say, Jeff, I don't know if this thing's any good. We're looking for Main Street, 21 Main Street, but I don't know if we're supposed to be in Cleveland or San Francisco. So what we figure out is, no. By the way, you see this right here? That's Green Bay Packer territory. You don't want to go there. You want to go to Chicago.
Correct.
And so you could tell the D-Wave to look in certain areas. And maybe that's the equivalent of changing a cubo. You would never change a cubo, but you could change where you look.
Well, I mean, the other thing is, I mean, a cubo is just you putting in values into a matrix and then running it through D-Wave. So if you had some kind of an optimization where you wanted to continue to build the cubo and keep moving, optimizing and then moving to another answer, optimizing and moving to another answer, maybe with time or something else, then yeah, I mean, it's just, once you've got your algorithm figured out, you can use it any way you want. I mean, we've just started using it to see what we can do with it. So, I mean, I was thinking of, there could be a time in the future where a lot of these quantum algorithms or quantum optimizations could replace things like an if statement. So rather than having a normal if statement, you could have if optimal. And then, you get yes or no, and then you move on with the rest of your classical algorithm.
So I'm going to interpret the question a different way so we have no, we never signed the NDA with Honeywell. At least I don't think we did. But I'm going to pretend I have an NDA with Honeywell. But I will say this. So I can interpret your question, Robert, as saying, could I measure in the middle of the calculation, could I measure the qubit? Could I say, are you a 1 or 0? And then come back. And so, but what Honeywell said was their trapped ions are so strong that you could actually measure, reset the whole thing, load your values and run again. You can run 2 compute cycles on the same qubit in the same cycle. Basically read, destroy, rewrite, go. D-Wave doesn't have that. You get one shot, and then your answer is a bunch of 1s and 0s. So hopefully we answered the question you asked, even if it might not have been the first question that you asked. Thank you. All right, you're welcome. All right, give us a hard one. No, I mean, come on. Really stump us. I love these calls because just to tell you the type of question, right? So we did a call like this, Zen for Quantum, and they were just on us about mutual funds, right? You got to go after the mutual fund market. And it made me think for like 3 weeks about that question. I love that. So, don't be afraid to ask questions that might seem off the wall. I will say that the D-Wave team has been very hands-off. So, and maybe they do this with all the research teams, but there's not really any help. I've become a master at searching the documentation and just trying things. It's not like they got a whole team. Like at Microsoft, they used to send cloud advisors to your office for free for as long as you wanted. If you were going to move cloud stuff, they just sat there and waited for a question. But D-Wave now, you really have to figure it out. So that's different. So the question, go ahead, Deb.
Do you have any other problems you try to attack except optimization using DOA?
This is the only problem that we have taken. I'm sorry. Yeah. Go ahead, Clark.
D-Wave only does optimization problems. It's a
Yes, I know.
specialized machine. Yeah.
Oh, I see. Okay. But you didn't try any other, any other problem with gate model or anything using?
So the gate models that are available now are still very tiny. You can't, right? Even as, I mean, I wrote like a gate model quantum computer on my laptop, and I can do 8, maybe 10 qubits, and I don't know, IBM can give us 20, but you know, you can't optimize anything on a gate model yet that you can't just brute force classically.
I don't know. The Rigetti model and cloud and all this, it's no use for the financial market?
Well, it is of use, but what I'm saying is the size of the problem is still tiny, relatively speaking.
I see.
It's still brute force solvable just by running through all the possible solutions if you're looking at trying to find the best optimal Sharpe ratio, for example. That will change. That absolutely will change, and that will change in the near future. But at that point, we will pick up like the variational quantum eigensolver, or we'll pick up the QAOA, whichever acronym you want to use out of that, or we'll pick up some other optimization algorithm which will show up, you know, Ross and Selinger, whatever.
But Chicago Quantum is only for this particular one right now.
So the real answer, let me give you the CEO answer. If you have a paying client that wants to pick up another type of problem, fixed income, Bitcoin, commodities, we are right here because we've learned how to make that QUBO sing. And so for paying clients, we will take on additional problems.
I see.
Yep.
Well, I mean, we are also looking at other optimization problems. I mean, I've got a COVID problem that I'm working with another team, and we actually have a client that we're working with that we are looking at a totally different kind of an optimization problem within a virtual environment. So we do have a focus on the financial portfolio optimization, and we're headed in the direction of creating a product for that. But it's not like, we haven't tried other optimization problems. And as a team, I mean, Clark has a lot of different experiences, and I've been teaching and doing other advisory work. So, we are getting exposed to a lot of different problems out there in the market.
Okay, thanks.
You're very welcome. So we had a question. Deb, are you DG or you're?
Yeah, that is, I mean, I just talked to you. I know.
The question is, what type of practical benefit do the optimizations give? So it's interesting because there's a question of, is the formulation helpful? So, and then the discipline behind using any formulation, is that helpful? So what I would say is we see a significant benefit to the Chicago Quantum Net score. We do. And when we built a portfolio and we tested it, it was materially better than the stock market in general. The other thing, though, is the discipline of looking for the best stocks. And let's say we just took 1,000 stocks and we produced a portfolio of 40 stocks. the discipline of like running it maybe once a week and making sure that it's the right type of return structure, it's a tremendous return. And if your cost was $50 or $150 to do this optimization, by the way, we have a product on our website, $50 without quantum, $150 with quantum. For $150, if you've got $1 million invested, it's a very cheap way to know if your portfolio has some losers in it and some stocks that don't move with the herd very well. And so I say it's a tremendous value, right? It only takes one client to make an extra $50,000 to pay for everything that we've done. And then we have another question about incorporating one-time events and stock markets into our model. So right now, this is not a trading model. It's a longer term. It's a year of data. So it does incorporate the COVID crash. But no, this is not like Tuesday morning news and now Tuesday afternoon trade. That would be a different structure of a model. It's not to say that Clark, Alex, and I haven't talked about it and can't build one, but that's not what this model is. Hopefully I answered both those questions really well. Please ask a follow-up if not. All right, so Vikas and Deb, if you're welcome, let me hand it back to you. We've gone almost the full 2 hours.
Sure. Thank you. Thank you very much for coming.